think that you don't know how the business activity statement system works. Do you know why I think that? Because there's $50 billion outstanding to the ATO as of March 2024. And I think a lot of that is cash flow problems with people not truly understanding what money is theirs, what money is the government's. And I've seen countless small businesses run into trouble and get buried under a pile of ATO debt and find it really hard to get out. So in this video, I want to explain how all this works and how you need to think about getting ahead of it so you don't get stuck. All right, let's dive into it. So let's talk through the activity statement system, which is essentially how the ATO collects its taxes from us. Why is it so important? Well, for me as a fractional CFO, this is critically important because it has a huge impact on your cash flow. Usually for businesses, each quarter they have a huge hit when they've got to pay their BAS, and often they forget about it and need to scramble to come up with the money. The reason that people forget about it is because these liabilities sit on their balance sheet. And here's a little hidden tip. This is my 10th year helping small business owners. Most small business owners don't look at their balance sheet or understand it or the movements. Or even if they do look at it, they're not making sure that their bookkeeper is reconciling it to the ATO portal. So you could have a tax debt there kind of ballooning and compounding, but if you're not updating your balance sheet in zero, you have no idea, you can get yourself into a lot of trouble. So this is why it's really important. It's kind of boring, but it's really important. Back to it. The second point, ATO debts are really expensive. They're more expensive than going to a bank for a loan because they're trying to prevent you from acting like a bank and just, sitting a big tax debt with them and not touching it. The third one is if you trade whilst insolvent, the ATO can come after you personally for some of these debts. So you can't think you're protected in a PTY LTD. If you haven't paid these requirements to the government, in certain situations they come after you. So that's why it's important to know this stuff. This is a huge part of why businesses go under. They get stuck in a debt trap. They have cash flow issues in the operations of the business, and then they let it run and they can't turn things around because of the compounding interest that the ATO charges them or the compounding interest on their credit cards that they've been using. This is a graph that really shows you how that happens. The ATO is charging about 11% in the general interest charges at the moment. And you can see on a 50 grand debt over a 6-month period, if you haven't repaid anything, that has ballooned up to 93 grand. So that's a huge increase, 87% increase in 6 months. So this is why you need to be on top of not getting into this position and making sure you're ahead of the game budgeting for this stuff. So we're going to quickly define what these terms are: BAS, IAS, GST, PAYG. They're all confusing as hell. Let's define them so you can better understand them, and then you'll know that you need to pay them. The activity statements, it's the system essentially how the ATO keeps track of what you're up to and, most importantly, collect its money. So it's not door knocking anymore, it's just looking at these statements. So the big 3 taxes that are on these things, GST, goods and services tax. Think about that as like a consumer tax. I'll define it in a sec. Pay-as-you-go withholding, and that's the amount that you're withholding on staff wages and you need to pay to the ATO on their behalf. And pay-as-you-go installments, which is basically your company income tax. And we'll define these a little bit further down. So the activity statement system is confusing. I'm an accountant and it's still confusing. They have business activity statements, which is quarterly, and installment activity statements, which is monthly. Installment activity statements don't have GST included, but they're often for bigger businesses that need to remit their pay-as-you-go withholding, so the staff-based taxes, and any pay-as-you-go installment on company stuff. I'm going to narrow my field to the majority of the ones that I see and just talk about BASs, talk about quarterly BASs, because that's what most of you will be used to. And some of you will have monthly IAS, but the BAS is essentially the main one I want to talk about. And that has your GST, withheld on staff wages, and installments for company tax. And the main difference, as I mentioned, one's quarterly, one's monthly. They're both due, a couple of weeks after the month end closes, and you need to remit that to the ATO. If you have a BAS agent or a tax agent, you get an additional month on top of this, and they'll keep on top of this for you. But even though you have a tax agent and a BAS agent doing this for you, you, the director of the company, need to know this stuff and you need to understand. Because as I said, cash flow problems, they're your problems. If you go into liquidation, they're your problems. So you can't just outsource this knowledge. Most people who are in business will basically be registered for GST. Once you hit 75 grand annual turnover, you have to do it. So you'll be on the quarterly BAS system from that point. The monthly IAS, that's when you have to withhold more than 25 grand on your staff's wages for the year. So once you grow up the business growth curve, you'll have to start submitting things monthly as well. So what the hell are these taxes? Let's define what they are so we can better understand them and then hopefully start to budget for them a bit better. So this is a company's P&L, and on the right is the tax related to each of those those steps on the P&L. So basically the ATO wants to be clipping the ticket all the way through. It wants to be maximizing its taxes so we can pay for everything else for our schools and roads and hospitals. So the way it does this, it will be collecting GST on the revenue you earn and be getting a little clip there. Cost of sales, you might have some expenses you claim there, so that's kind of GST related. On your labor bill, it has that pay-as-you-go withholding tax, and so that obviously goes back to the government via your team members. You know, that's their income tax that the ATO will eventually get. And once the business get big enough, I haven't put this one here, is payroll tax, which is a state-based one. No one really knows why that is. You get big enough and you need to pay a payroll tax. It's ridiculous, but anyway, that's not there. GST, you'll be able to claim some GST on the expenses you're paying. That'll lessen the GST bill for you, but that's kind of GST related. And then the last step on our P&L, the net profit, that's the company income tax. And that's the pay-as-you-go installments we're going to talk about. So as you can see, the ATO has you covered at each. On your P&L, it's trying to clip the ticket somewhere. Let's talk through the big three ATO taxes and the most common. Goods and services tax, pay-as-you-go tax withheld on your team members' wages, and pay-as-you-go installments on your company income tax. So when I say company income tax, I'm talking about your net profit down here, and then it'll be times by probably the small business rate of 25%. Those are the three big ones you need to know. And little bonus, superannuation. So super's not paid directly to the ATO, so it's not on the activity statement because super is paid directly to the employee's super fund. So even though it's not kind of part of this activity statement, when I'm thinking cash flow for clients, you need to budget in paying your team members super each quarter as well. So don't get caught out just budgeting for your activity statements. Super is another one that everyone forgets about, and then that bill comes quarterly as well, which is why I've included it. So it's not on the activity statement because the ATO doesn't get it, but it goes somewhere else. You still need to have the cash, and they can still come after you if you haven't paid it. That's really important because it's not your money, it's your team members' money. All right, this is the first one, goods and services tax. It's essentially a tax on consumption where value is added. It's essentially borne by the end consumer. So when you go to the supermarket and buy something with GST, you're the one that's kind of wearing that tax, essentially. You can see all the way through the journey from a producer through to the consumer, people selling their product with GST, but they're also claiming a portion of their expenses of GST. So all the way up the value creation ladder, government will be clipping the ticket a little bit. And essentially it's a way to try and tax the volume of stuff going through the economy. Confusing, I know, but we all have to do it. This is an example of how it's calculated. It's fairly simple maths. If you think about this company, it's collected $220 for the quarter, and 200 revenue plus 10% on top is 220. Those two portions of GST at the top is your GST on sales that you've collected. And say you've paid 110 bucks in expenses, so 100 bucks in expense, and then the extra 10%. You can see the bottom of the calculation, the two squares of GST is 20, GST on expenses is 10, and then basically you net them off to work out how much you owe the ATO, so you'll be owing the ATO 10 bucks. If you make a loss for the quarter, say that's reversed, then the ATO will owe you 10 bucks, which is kind of good, but you made a loss. So you'd probably rather be paying the government some GST because it means you're making a profit, things are going well. The next one on the confusing list is pay-as-you-go withholding tax. So withholding on wages, that's how I remember it. First thing to note, it's not your money. It's the income tax that your employees will pay on their wage, but you just don't pay them and you give it straight to the ATO because the ATO does not trust us to give it to them. They want it straight away. And that's essentially where the tax systems is moving. They want it kind of straight away eventually, and so they don't have to chase debts. It just happens when the transaction happens. That's where we're moving essentially. And it's calculated based on that individual's marginal tax rate. So that will change depending on the individual. If you have zero, this will automatically calculate it for you. And as I mentioned, it's withheld. So it's sent directly to the ATO as we can't be trusted with it. And then you'll see, if you've probably seen a pay slip in your life, you'll see total earnings, you'll see the taxes up here, 2840, that's the amount that's withheld that you then need to pay to the government in the quarterly BAS, or if you're a big company, that will be paid monthly in the monthly IAS. So that's essentially what we're talking about with the withholding. Let's talk about the third one, pay-as-you-go installments, aka basically your company income tax. So the whole purpose of this one is for the ATO to gradually collect your company tax each quarter, kind of in the quarter that it's earned, so you don't have a big fat tax bill at the end of the year. because obviously the bigger the bill, the harder the cash it is to come up with. Humans naturally don't like big piles of money. We try and squirrel it away or spend it. So they're trying to collect it more regularly so you don't get hit with a big bill that you don't have the money for, essentially. So the way it works is they'll estimate based on last year's tax return how much tax you'll pay this year, and then each quarter collect basically a quarter of that. There's ways to change the installment based on the changing trading conditions, so you can vary it, but that's the basic idea behind it. So if you lodge your installment on time and you've had an absolute shocker of a quarter, you can vary it down saying, hey, we've had a shocker, we've made big losses, that we'll be paying no tax for this quarter. You can adjust that amount, but essentially the idea is they estimate what profit or what tax you paid last year on your profits and then try and estimate it for this year based on that. So here's a really simple calculation as a way to look at it. This is a $3 million agency. They've made a decent net profit, 30% net profit, 900 grand, and they're a small business, so they pay 25% income tax on that. And then from that 225, a very basic estimate would be, all right, 225 from last year's tax return, divide that by 4 for this year's 4 quarters, and then that's what you owe us each quarter, because that's kind of what you paid last year. But as I mentioned, there's an ability for you to adjust that amount up or down depending on how you're actually going in that quarter, and if things have fallen off a cliff, you can reduce that. But that's essentially the idea. Chip away and collect it more regularly so they don't have a big fat debt. As I mentioned, they've got $50 billion outstanding with Australian citizens at the moment. That's a lot of money. So they're trying to avoid that by collecting it more regularly. All right, bonus item, superannuation. Already spoken about it, but it's not paid to the ATO via the BAS. It's paid directly to the super funds for our retirement. It's 11% at the moment. It's been creeping up bit by bit, and it's still paid quarterly. So kind of when you're thinking about budgeting for your cash flow, think about it on a quarterly basis, but it's not actually paid in the BAS. But if you have auto super in Xero, it makes it super easy. You just plug in the employee super fund numbers and you can do it there as well. But the main thing from my perspective as a fractional CFO is, do we have the cash set aside for it? And that's the whole purpose of this video. Make sure you got the cash. You'll see that on the pay slips and stuff, the superannuation up here, and that's the 11% on their wage in addition to everything. So that's the summary. You've got GST, which is a tax on consumption. You've got PAYG withholding, which is just staff income tax, and you take it from their wage, you pay it to the ATO because they can't be trusted, and pay-as-you-go installment tax, which is generally collected quarterly because they want it up front, again, because you can't be trusted to pay it when it's due because it's a big fat bill and they have trouble collecting these. So all they're trying to do is, in the period that the action happens, they want to collect all the taxes related to that period. And that comes in 3 different forms here. So, what to do? An actionable step for you. I want you to avoid debt traps. I've seen a lot of small business owners that have come to me under a big cloud of debt, a big cloud of ATO debt. I've had a huge win recently I'll do a separate video about, but we managed to get them out of some of this. Don't get stuck in that debt trap. So the simplest strategy for you is to put around 20 to 30 cents of every dollar that you earn into a different bucket. It's not yours, and make sure you have it set aside and don't touch it because it will come up for one of those key reasons. And understand your cash flow. So on a deeper, more nuanced level, build out a forecast, build some reserves in your business and plan for that quarterly hit, because it's going to happen like clockwork, and putting money aside for it will help reduce your stress levels massively. All right, thanks for sticking around. I know it was a long video. Hopefully you got some value from this, and on the next one, we're going to go into a little bit more deeply about the forecasting behind it and how to think about each of those that are calculated. All right, thank you for watching, and I will see you on the forecasting one in a sec. Cheers, bye.